This week, the market is telling two completely different stories at the exact same time. You've got geopolitical tensions lighting a fire under oil prices, while on the other hand, some pretty disappointing corporate earnings are pulling tech stocks down. It's a classic tug of war, so let's try to make sense of it all.
It really does feel like a market tug-of-war, doesn't it? On the big picture, macro side, you've got these major international events pushing some assets way up. But then you zoom in to the micro level, and individual company performance is pulling that positive feeling right back down. These conflicting signals can be super confusing. So in this explainer, we're going to break down these forces and see what's really driving the market.
So before we dive deep into the why, let's start with a quick look at the what. Here's a snapshot of this week's market pulse.
Okay, so US equities are basically flat. The S&P 500 and the NASDAQ 100 barely moved. But the real story here is over in commodities. Just look at crude oil, up a massive 5.49%. That is a huge move, and it's the first thread we really need to pull on. Over in currencies, we're also seeing the dollar flex its muscles against the yen, with USD/JPY up over 0.5%.
Now, that massive jump in oil prices, it didn't just happen in a vacuum. The main reason, the primary driver, was a major policy announcement from the White House, and it was aimed directly at Russia. This quote from President Trump is a really big deal because it signals a significant shift in policy. These are actually the first sanctions he's introduced against Russia in his second term, and it really marks a pivot to a new, more direct strategy of applying pressure. And this number right here, this just perfectly illustrates the market's instant reaction. A nearly 5.5% surge in crude oil is the market pricing in a potential supply disruption. I mean, it makes sense, right? When you put sanctions on one of the world's largest oil producers, traders immediately start betting on scarcity.
So, what do these sanctions actually do? Well, they're specifically targeting Russia's biggest oil producers. The strategic goal here is to cut off the money Russia is using for its war effort in Ukraine. It's not a quick fix, but it's designed to make the war much harder for them to sustain by hitting their primary source of income.
All right, now let's completely switch gears to our second major theme. While oil traders were totally focused on geopolitics, stock traders were dissecting corporate earnings. And one of the biggest names out there, Tesla, gave investors a whole lot to worry about.
This slide shows a real paradox. I mean, look at this. On the left, record vehicle sales. Customers were literally rushing to get tax credits before they expired. You'd think that would mean record profits, right? Well, nope. On the right, we see that profits plunged, and by more than expected. This complete disconnect is what sent the stock tumbling in after-hours trading.
So why the disconnect? Well, the details show that even a company like Tesla is not immune to these broader economic pressures. Their operating costs soared by a staggering 50%, with a $400 million hit coming directly from tariffs. It's a perfect example of how, even with incredibly strong sales, rising costs and trade policy can completely undercut the bottom line. Okay, so with these powerful forces pulling the market in opposite directions, how can we possibly gauge the overall mood? One of the best tools for this is the CNN Fear and Greed Index. It's pretty cool. It combines 7 different indicators to give us a single reading on market sentiment. Let's break down how it all works. All right, let's run through these components rapid fire. First up, the index. Checks the market's overall health with market momentum. Is the S&P 500 trading above or below its long-term average? If it's below average, that's 1 point for Team Fear.
Then it looks a little deeper with stock price strength. We're asking, are more individual stocks hitting new year-long highs, or are more of them hitting new lows? A rising number of lows signals some underlying weakness.
And that gets confirmed by stock price breadth, which looks at trading volume. A rally is a lot more convincing when it's backed by heavy buying. If that volume dries up, it suggests the rally is running out of steam, another sign of fear. Next, the index looks at what the professional traders are betting on. The put and call options ratio is key here. Puts are basically bearish bets, calls are bullish. When traders start buying way more puts, they're preparing for a drop, and that signals fear.
This ties directly into market volatility, which is measured by the VIX, often called the fear gauge. When traders start expecting big price swings up ahead, the VIX goes up. And a rising VIX is a classic sign of market anxiety.
And the final piece of the puzzle is all about risk appetite. Are investors playing offense or defense? We see this in safe haven demand. When money flows out of stocks and into the relative safety of government bonds, that's a classic defensive move.
And we also see it in junk bond demand. See, investors demand a higher payout to own riskier junk bonds.
When they get scared, they demand an even bigger premium, and that yield spread gets wider. A wider spread just screams fear.
So beyond the current sentiment, the market is always looking ahead, always trying to predict the next move from the world's most powerful central bank, the U.S. Federal Reserve.
And you know what? We don't have to guess what the market is thinking. The CME Fed Watch tool does the work for us. It analyzes pricing in the futures market to calculate the probability of a rate hike, a cut, or a hold at the next Fed meeting. It's an incredibly powerful snapshot of market expectations.
And right now, the market is speaking with a very, very clear voice. There's a 92% probability priced in that the Fed will just hold interest rates steady at its next meeting, with only a tiny 8% chance of a cut. So for now, the market is definitely not expecting any big policy surprises from the Fed. So, what could possibly change this whole picture? Well, let's look ahead at the key data points and events on the calendar for the rest of the week that could really move the markets. Based on data from sources like investing.com, we've got a few important releases. Today, we get initial jobless claims and existing home sales, which give us a nice pulse on the labor and housing markets. But the main events, the real blockbusters, are the big tech earnings. We have Intel and Microsoft on October 23rd, followed by both classes of Google stock on the 24th. After that big miss from Tesla, all eyes will be on these tech giants to see if they can support the market or add to the pressure. Which brings us to our final question, doesn't it? We have geopolitical tension pushing oil up, and we have earnings pressure pushing tech down. Sentiment is balanced on a knife's edge, and we have a slate of absolutely critical earnings reports just ahead. So the big question is, which force will prove stronger? Will fear or greed win out? Thanks for watching. Don't forget to like and subscribe.